Hello everyone, my name is Roman Sandoval. I'm one of the members of the CQA Investment Challenge team at UCLA Anderson. Our name of the company we decided to call Bring Capital in honor of the UCLA team. So the rest of the students that we form the team are Hushang, Andrea, Taran, and myself. And we would like to thank Professor Ehud Peleg, he was our faculty advisor, and Rosemary Macedo as our industry mentor. Thanks to them because they helped us during all this process and to come up with the following strategy. So we're going to talk about these 4 points. I'm going to speak about the investment philosophy and process. Then Hushang is going to talk about the alpha model. Then Andrea will go over portfolio construction optimization. Finally, Taran is going to talk about the results of our backtest and the portfolio analytics. So before starting, we wanted to make a little bit of background of the UCLA Anderson MFE program, because these 4 lectures help us to create the strategy that we are going to present next. So the first lecture is called Empirical Methods in Finance, which was an advanced econometric lecture where we learned how to better use the time series analysis, stock return predictability, and how to model volatility using GARCH models, for instance. Then we took these 2 lectures, Cognitive Asset Management and Behavioral Finance, which were pretty much the base of our investment philosophy, which means that we learned to create alphas, how to come up with alphas, test them, and to write the report. And finally, we would like to say also that during this project we use a blend alpha model and some shrinkage in the optimization model, which was part of the statistical arbitrage lecture. So during the investment process, I think in each investment process, the first part is the universe, to find the data, and in this case the universe was the Russell 1000 with the data we got from data stream. So we decided to put these 3 active filters. The first one was within one cheap penny stock, so we decided to put this filter of the price was going to be higher than $5. And then we also wanted to have a history in the returns, so we decided to that each stock must have be listed for at least a year, and at least one analyst covering the stock. So this is our investment strategy in the overall. So once we have the data, we had to provide the data to the alpha model, the risk model, and the transaction cost model. Then those outputs, when transformed, were given to optimizer, and from the optimizer we found the systematic trades that we are actually computing and using in stock track. So now Hushang is going to go over the first of the 3 components, which is the alpha model.
Thanks, Roman. Regarding the alphas, first, before we start, I want to make sure, what is an alpha to us? An alpha is a signal or source of expected return, which is beyond what is explained by the market or the market beta. So what we do is we first take the raw signal. So say, for example, straight momentum. We first take the raw signal, which is the 12 minus 1 returns for every stock, for any stock I at given time t. We take the mean, cross-sectional mean, and we take a standard deviation, and we standardize this particular raw signal cross-sectionally for any given point in time. And then what happens is we get a z-score for this particular raw signal, and with a mean of 0 and a standard deviation of 1. But you still have a lot of outliers, and a signal can, for an alpha for a particular stock can be, say, for example, 20, which goes into the optimizer, and you don't want the optimizer to overweight that particular stock. And so we cut off the tails and Winsorize this particular alpha for every stock I. We do this process for all the alphas in our model, and next we will see that the alphas that we are covering. Broadly, we can categorize alphas into these 4 buckets: shorter-term alphas and longer-term alphas, pro-cyclical alphas and contrarian alphas. Each alpha balances one another out. Our idea is that every alpha has a distribution, and to get a more finer signal and cut out all the noise, we take a more blended version from all the alphas within each of these 4 different buckets. So let's start with the long-term pro-cyclical, which is the momentum alpha bucket. We use a momentum blend instead of just using one momentum signal. We take the blend of straight momentum, the classic Jagadish and Pittman paper, echo momentum by Robert Noe Marx, and momentum acceleration strategy, which was outlined by Gettleman and Marx. We form a composite momentum alpha blend, which we use it in the final overall alpha blend of our strategy. To balance out this long-term technical signal, we use another technical signal, which is a price technical signal, the contrarian short-term technical signal, which is the 1-month reversal. We just take the 1-month returns for any stock I and perform the D-mean standardization like you've seen before. To balance out these technical signals, we use fundamental alphas, and we go into long-term fundamental, which is long-term contrarian, the value alpha. And instead of just using book to market, we use the LSV approach. We use cash flow to price, we use a sales to price ratio, and a ROE for every stock. These 3 form the backward-looking value alpha. We balance this particular backward-looking value alpha with the forward-looking ones, which is using analyst estimates from IBES, the FI1 earnings to price, the FI2 earnings to price, and we also use something else, which is the change in shares outstanding, as we have seen that SEOs do have some return predictability. Going into the short-term pro-cyclical bucket, we have change in analyst recommendations. As we all have seen that just pure analyst recommendations do not have predictive power, but change in an analyst recommendation will have some predictive power. So if an analyst upgrades a stock from a strong sell to a strong buy, there is a price shock in the stock, and then it drifts over time. So what we do is we finally combine all of these 4 buckets, all of the alphas that we've discussed, into a final value blend, and use this as our expected return model, which is fed into the optimizer. Andrea will be covering the risk and transaction cost model.
Thank you, Hoshan, for introducing the alphas. Now I'm going to talk about the risk model. We use a covariance matrix shrinkage method based on Edwards and Wolff. We use this in order to overcome the problem of matrix invertibility. We're using this because we don't want to use the simple covariance matrix. As we all know, it causes it causes a lot of problems because we can have portfolios that might seem like very safe at first sight, but those portfolios can have very misleading results, and we'll tend to overweight them, and that will not be like proper. So in this case, we're gonna have this method based on Edwards' paper, in which we're gonna shrink our simple covariance matrix towards the shrinkage target, and then we'll use a shrinkage estimator that will have this equation. It's based on a linear combination. This shrinkage intensity will also be mentioned on the paper if you wanna go in depth. Then we're gonna talk about the transaction cost model. In this case, we use a commission of 1 BP as well as median bid-ask spread divided by 2. We did this in order to incorporate in a very simple model into our complete trading system. For this purpose of this competition, we use 50 bips for the investment challenge, but as well as we mentioned, we're trying to build a system that can be replicable and easy to handle, and this way we have this model. We then have all the ingredients that we get from the data. We have our alphas, we have the risk model, and as well as the transaction cost. So these data that we collect, we're gonna feed it into the optimizer, which is a very important piece of our trading strategy. And I think that will differentiate against other groups, because we're not trying to get alphas, but actually we're trying to improve and get a systematic trade out of this. So what we're trying to do here is trying to maximize our alphas, as well as control by our transaction cost here with lambda parameter, as well as trying to minimize our risk exposure. We have this equation that we solve by using the quadprog function in MATLAB, and we have this subject to this parameter that was it was used by the competition rules as well, and we'll have our lambda value of 20 and the mu that control the risk of 2x. Our maximum position size is 3% long side of the book, as well as our maximum industry exposure, it's 50% long side of the book, and our book size is 10 million. This 10 million, as we all know, is 10 long and 10 short, and our number of trades that were actually already started, it's counted to be 40 on the long side and 40 on the short side, and we'll have balancing frequency of 1 month. So this will all be our trading system, and my colleague Taran will explain the results of this trading strategy. Thanks.
So thanks Andrea for describing the optimizer. So we have alpha model, optimizer, and the transaction cost model, and we use all the data to generate trades. So let's look at what our strategy did. So the first thing is the P&L chart. So we actually tested a strategy with 10 million invested, and here you see the unlevered P&L. And the red one is our strategy, and we chose S&P 500 total return index, as you can see it in the blue line, and we chose a backtest period from 2007 to 2014 because we wanted to cover the financial crisis. You can see this portion here. This was the period when a lot of long-short hedge fund managers actually ran out of business, and our strategy actually does pretty well. So let's look at some further statistics. So the next is we just compiled a brief performance summary which details some popular metrics. I would like to highlight the mean geometric return against the S&P total return index. It beats the index on an annualized basis, and the volatility is fairly low, which leads to a very decent Sharpe ratio of 1.37. This Sharpe ratio is realizable. We have covered transaction costs in our backtest, and we actually test for liquidity of stocks that we are trading in the portfolio, so we believe the results are sound. So let's look at some further metrics. So we wanted to test our results against a popular academic factor model. So we chose the Fama-French Kapka-Hart 4-factor model, and we did a regression on the daily returns, and we actually find that we have an alpha of 8.37%. Our geometric mean return is 8%, so all of our return is actually pure alpha as per the data that we have. So as you can see, the exposures to the factors are actually close to zero, and the R-square of this particular regression is less than 1%. So that's the results on this, and going forward we have drawdown chart. So here you can see that again the red one is strategy, and the drawdown is actually fairly low compared to S&P. So especially in this portion where we had the financial crisis, at the height of the financial crisis, our strategy is in a drawdown, but it's not deep. So and that's a good feature, we believe. Okay, from drawdowns we move to the total distribution of daily returns. So we have plotted this because we wanted to show the third and the fourth moment, which is visible in this box plot. On top we have S&P 500 total return index, and this is our strategy, unlevered daily returns. I would like to get your attention to the third and the fourth moment. As you can see, our strategy actually has almost 40% lower skewness and much lower excess kurtosis compared to the S&P total return index. And now we just compare the quarter by quarter basis comparison against the S&P index, and we can see that some points here when the actual index was in a deep drawdown, our strategy actually performed really well time period here, and this period is the quant crash of 2011, and the strategy actually had a handsome 8 to 9% return in that quarter. So we believe our strategy is pretty good. We have done robust research. We actually refer to a lot of academic papers to come up with the investment ideas. And this is not the end for us. We are still working on some more alphas like post-earnings announcement drift. And we also trying to look at employee calls, Q-based signal. And we also believe that all the alphas that we have chosen, they're good. But some of the alphas work in some periods, some of the alphas don't work in some periods, which actually led us to think about alpha modulation, and we are actually working on VIX-based modulation for our technical signals and some contrarian signals. Basically, when VIX is high, we believe that contrarian signals actually perform well. We still are testing this idea. And then we also have a Petrosky F-score, which is more like a quality signal for the fundamental alphas that we have. We think that if we use this to modulate our alphas, we can actually have a better risk-adjusted return. So, and lastly, I would like to thank our professor, Professor Olivier Letois, who actually took the statistical arbitrage course at UCLA Anderson, and he actually taught us the nitty-gritties of how to actually use an academic investment idea and turn it into a practical strategy. So we've actually used a lot from his class, and we are really thankful to him. And this concludes our presentation, and we hope you all enjoyed it, and we'll be sending over this presentation along with the video, and in case you want to look at it at your own pace. Thank you very much.